next speaker is Kagisho Mahura, who is the co-founder of Gradidge-Mahura Investments with his partner Craig Gradidge. Both Craig and Kagisho were in comfortable corporate careers when they took the big decision to start their own business. And this was a big decision for anyone, but particularly in the context of South Africa and its history of racial discrimination. The fact that they are a black-owned financial planning business and one that has won a number of accolades along the way is both relevant and interesting, I'm sure, for not only people in South Africa, but those of you in other parts of the world. So we look forward to hearing your story, Kagisho, and thank you very much for being part of Humans Under Management this year. Over to you.
Good day, ladies and gentlemen, and thank you very much for joining us for this presentation. My name is Kagisho Mahura, and I would like to thank Humans Under Management for the invitation to come and talk to you about the Gradidge-Mahura investment story in the context of building a Black-owned financial planning business in South Africa. Our story is really a story that started as a conversation. It was a conversation that took place between myself and my business partner, Craig Gradidge, in a canteen at one of the leading financial planning and financial services businesses in the country. It was a conversation that centered around what was happening at the country at that point in time. It was a season of Black economic empowerment, public deals. It was deals like Phuthuma-Nathi that were happening, and Phuthuma-Nathi was an opportunity for Black people to purchase shares in DStv or MultiChoice. It was a season of deals like Thembeka Capital, which was an opportunity to buy shares in a group of companies that included the likes of PSG and Capitec, amongst others. But the deal that really caught our eye at the time was a deal that was offered by the National Empowerment Fund. It was called MTN Asonge. And what this transaction was about, it was NEF selling its MTN shares to the Black public at a discount of about 45%. But when this deal was done, out of the millions of people that could have participated, only 85,000 people had actually bought these deals. This was quite surprising for us. We could not believe that these wonderful opportunities were being presented to the market. I mean, the Phuthuma-Nathi shares were offered at 10 rands a share. And as you can imagine today, they're trading at over 100 rand a share. So these opportunities were being presented to the Black public, but the people were not participating. So as we're having this conversation, we start to realize that people are not investing not because they don't want to, but because they simply do not understand. Because of the history from which we come, they don't understand how investments work. They don't understand how buying shares in these wonderful companies can create incredible wealth for them into the future. So while we were having this conversation, it started to become quite clear to us that we were having a dream. We were there in the same space. It is almost as if fate had put us together. It was really a meeting of minds. We were having this dream, and it seemed to us like we were having the same dream at the same time. And this dream was saying, something is happening in this country. Something is taking shape, and we need to do something about it. Oh yes, we were young, we were bright-eyed, we were bushy-tailed. And both of us are truly quite determined individuals. We had a little bit of that thing, that South African determination that spurs us on to try and change the country into a better country. That determination that wants to inspire us to bring opportunities to those who have not seen opportunities before. So what was happening in the country? We're now talking the early 2000s. It had been over 10 years since apartheid had ended in South Africa. So the country was changing. Black people were being integrated into the formal economy. So there was an emergence of young Black professionals that was taking place. And this emergence was driven primarily by two pieces of legislation. The first one was the employment equity legislation. What this was doing, it was opening up senior management and executive positions in companies across the country. And therefore, these young black professionals were starting to earn a lot of money that they had not had an opportunity to earn before. The second piece of legislation was the Black Economic Empowerment legislation. And this legislation was requiring companies to offer shares to black individuals. Some of them chose to go the public route, like the deals I explained earlier on, and others decided to go the route of offering these shares to their own staff, to their own black staff, particularly the black management within those companies. So what essentially was happening because of the legislation is that we were getting young black professionals whose income statements were changing and changing very quickly for the better. But at the same time, the BEE legislation was allowing them an opportunity to fortify their balance sheets and to buy assets that could create incredible wealth for them into the future. So clearly, a young black middle class, a young black affluent class was starting to develop within the country. However, there was a problem. While the country at large was changing, while the market that we serve in financial services was changing, our industry was not. The financial planning industry was not changing at the rate that the market was actually changing. What research showed at that time was that the average financial advisor was a 52-year-old Afrikaans-speaking male. So on the one hand, we had a group of emerging professionals creating young families, seeking advice. But on the other hand, the average person that was there to advise them was not quite understanding the new market that was developing. There was a clear culture clash where two groups of people that were not really seeing eye to eye. And it's so, and as they say, they were butting heads. Because by its very nature, financial planning is quite personal. What this black middle class was feeling was that the people that were available to advise them were not quite understanding their needs. They were not understanding their cultural nuances. And therefore, they were not quite giving them the advice in the manner or in a form that they actually liked or understood. The second problem with the market that was serving this black middle class was that they were not incorporating these public BEE shares that I spoke about. They were not incorporating the employee share option schemes that these black professionals were participating into their financial plans. Maybe because they didn't understand them, or maybe because they were excluded from them and therefore did not see the need to integrate them into the financial plans of this market. We knew this because we ourselves were part of this market. We too felt like this industry was not meeting our needs and not understanding the challenges that we were facing as individuals. As Mahatma Gandhi said, be the change that you want. So we knew that if this narrative was going to change, we were going to have to be the ones that would change that narrative. But we also knew that the way to see a problem is not to see the problem, but to see the opportunity. So not only were we going to have to be the change that we were looking for, but we were going to not be part of the problem, but be part of the solution. And that, ladies and gentlemen, is really the genesis. That is the birth, that is the beginning of this company called Gradidge-Mahura Investments. From that conversation, we started to see that what we're going to have to do is build a wealth management business. But not just any other wealth management business doing the same as everybody else. We wanted to be the leading private wealth management company in South Africa. Our ambition at the time was to not only compete with the leading private wealth managers in the country at the time, but we wanted to create a business that by the year 2020 would have a national footprint in the major metropolitan areas and manage assets in excess of 1.5 billion on behalf of our retail clients. But we knew that a couple of things would have to be done differently if we were going to achieve this vision and this ambition that we had set for ourselves. The first thing is that we would have to offer value of advice to our clients. We would have to give advice and not sell products. We knew that we'd have to set processes and a philosophy that was centered around critical, comprehensive, advice-led analysis and not about selling products to our clients. The second thing we knew we'd have to do is that we'd have to be client-centric. What that meant was we'd have to put the client at the center of our business. And that would mean that if a product is not good for our client, it will not be good for us. And we'll know in this industry that there's a lot of products out there that pay advisors very well, but represents very little value for our clients. And we were quite clear that we were never going to present those type of products to our clients, primarily products like upfront commission, investment-led products. The third thing we said we would get right, because one of the biggest complaints our market was talking about is how they will see a financial advisor once, but once their fees are collected, their commissions are paid, they never see that advisor again. We were quite determined that our business would be the kind of business that sees our clients often. We would create opportunities to interact with our clients outside the financial planning cycle. So we would create investment forums, we'd create family-led activities so we could participate in activities with our clients outside the normal financial planning cycle that we would have in terms of reviews, etc. However, if that is the kind of business we were going to develop, we knew that we'd have to raise money. We would have to raise capital to capitalize our business to allow us to build the type of private wealth management business that we had dreamed of. So we'd have to develop a different financial model, and this business financial model would require us to raise debt or to put equity into our business. We also knew that RDR would be coming. It was inevitable. Upfront commissions was not an option for us, not only because of RDR, but because we knew it was also not good for our clients. But to raise traditional debt, one needed collateral. We were young, we did not have enough assets to provide as collateral. So traditional debt funding was a bit of a challenge for us. So the other alternative was then to put equity into the business. But given our historical context, we didn't have the money, and neither did we have the networks that were required to capitalize our businesses. So we did not have the friends, the uncles, the grandparents that would provide us the money we wanted to put into our business so we can start this wealth management business that was going to be sustainable over time. So we had to turn to the banks. What we found out with our commercial banks at the time is that our commercial banks were incredibly risk averse. It was 2008. We had just had the worst financial crisis that the world had ever seen. They were not willing to part with their money. But they also did not understand our business plan. We found out that the credit committees of these banks simply did not understand how financial planning businesses make money, and therefore how we were going to repay them. So they were being quite punitive. Most of them turned us down. Only one of the banks, after looking at our business plan, was willing to offer us money. But the capital they wanted to give us was half what we requested, and the interest rate they required us to pay was prime plus 5%. Prime at the time was 10%, which means we're going to be paying 15% per annum to finance and to repay this debt. When we looked at that deal, we thought between the taxes, which is working for the government, and the interest rate we have to pay to this bank, we're going to be working for the bank and for the government for a very long time before we start to make money out of this business. So that deal was dead in the water. So our only alternative was then to turn to government funding agencies, like the National Empowerment Fund. They were just equally inefficient and ineffective as the banks were. They didn't understand our business plan, and they didn't understand how we're going to pay them back. And surprisingly, they also required quite large sums of collateral. We had to go back to the drawing board. We had to go back and say, how else can we raise the capital that we're looking for? Then we realized very quickly we would need a little bit of help from our friends. If we're starting a financial planning business, The best place to go then, we realized, to raise money is to go to businesses that understood how financial planning businesses worked. And that's where the likes of Old Mutual and Sanlam came into the picture. We also knew that those businesses had enterprise development funds, but they also had corporate finance divisions that would be able to look at our business plan and know that it made some sort of sense, and therefore they could lend us some money. We also realized that it's not just finances we needed, we also needed help with infrastructure. And then the banks of the likes of Deutsche Bank and Stanley came into the picture at different stages during our lifetime. What they were able to offer us is that they realized that on their BEE scorecard, there were different elements, not just equity or ownership, that there was preferential procurement in enterprise development. They owned or were renting out real estate, they were renting out space, they were paying for it. If they could cordon off some of that area for businesses like our own to occupy, they could claim some of that space on their BEE scorecard. And that's how they started to help us in giving us infrastructure so we could build our businesses. And over time, Catalyst Fund Managers also joined the fray by also giving some funding to our business. One time was an interesting one. As an airline, one of the most wasted spaces is a free seat in a flight. So our approach to them was very similar to the Stanley and Deutsche Bank structure, where we said to them, we are a young business, we are looking to build a company that's got offices in Cape Town and Durban, and we therefore need to travel to those areas. What if they offered us those seats that were empty, and then they could charge us a preferential rate, and then the difference they could claim on their scorecard? And they thought this was a brilliant idea, and they allowed us to actually literally fly across the country at preferential rates, and that's how we were able to develop our Cape Town and Durban offers over that time. So the story really here is we had to think outside the box. We had to go back and rethink, given the time in which we started the business, given the challenges that we were facing, given the legislation that was around, what were the opportunities that were there for us to raise the money, but also get the infrastructure support that we were looking for. Once the business was up and running, we then started to realize a couple of things about this market that we wanted to serve. It was this market that is known as the sandwich generation. What that means is that not only do they have to take care of themselves, but they have to take care of their parents and, of course, their children. So there's huge pressure on the income that these young Black professionals were getting. They're also highly educated and sophisticated. So the traditional processes and products that were used by financial planners were not going to cut it for them. They were looking for something different, something sexy, something sophisticated. And that's when we started to market the products such as private equity to this market. And that also made us stand out. We also found out that this generation is generally the first group of wealth accumulators in their families. But they were also in consumption stage, which means they were spending more money buying goods instead of investing. They were buying properties, they were buying cars, they were buying white goods for their homes. And therefore, they didn't have a lot of disposable income for us to invest on their behalf. They also were young, so they did not have large discretionary investments that they had accumulated or inherited over the last couple of years. They also did not have large retirement lump sums. They were quite far from retirement. So unlike our compatriots and our colleagues in the market, there was not a person that was going to come around and give us 10 million rand at retirement for us to invest for them. The other problem we had to deal with this generation was that they were incredibly negative towards financial planning. The only experience they had had before financial planning was through their parents, where somebody came around, sold them a life insurance product, and never saw them again. And now that their parents were retired, they could not afford those premiums, and these policies were lapsing. So they were not keen, and they were not ready to really start doing business with us. It is at that point, ladies and gentlemen, we knew we had a problem in our hands. We knew we'd have to be patient. We knew we'd have to take a long-term view if this business was going to succeed. We would have to grow with these clients of ours. We would have to educate them. We would have to take them through the steps slowly but surely, and over time, as they got to understand how the industry works and the investments world work, then we'll be able to open up those opportunities for themselves and for us. And a lot has happened since then. 12 years later, we sit here, and we can proudly tell you today that in 2018, Intellidex, in the survey that they do for top private banks and wealth managers, they awarded us the top wealth manager award in 2018. Not only the overall category, but we had actually won the boutique category as well. They also had an archetype called Lump Sum Investor that we came top in, and another archetype called Young Professional that we also won. We were also awarded the People's Choice Award in 2017, 2018, and in 2020 again. And this year, we also came second in the top boutique wealth manager survey. The Financial Planning Institute awarded us the Approved Professional Practice designation in 2016. This is a designation that they only afford or has given to 16 practices across the country. We are the only Black-owned and Black-managed practice to be awarded this designation. In 2015, Masthead started what they called the FARD Seal of Compliance. There's a compliance seal that they offer to those practices that rate 85% and above in their compliance. And they've awarded us this seal every year since 2015, and they did it again in 2020. Ladies and gentlemen, the story of Gradidge-Mahura Investments is a story of triumph over adversity. But I really don't believe that this story of triumph over adversity is a story that's unique to Gradidge-Mahura as a business. I really believe it is a story of South Africa as a country. Many, many times in our history, people have thought that the adversity that we were facing, we would never overcome. The case in point is this rugby team that went to the World Cup last year, that people were saying negative things about. People were calling them quota players. People were saying some of them don't deserve to be there. But our theme for this Rugby World Cup was that stronger together. We are indeed stronger together. We have proven it over and over again as a country. And now though that as an industry, we most definitely are stronger together. Yes, we are stronger together. However, there's still a lot that we can do. We need Black financial planning practices that can serve the needs of our country. We still have insufficient support for these Black practices, especially from our enterprise development funds. So to the members of the audience that sit in our product providers and that sit in these committees that give money to the industry to develop Black practices, the challenge for you is to make sure that those funds reach the businesses so that we can create more and more successful Black practices so that people of our country can get the advice and service that they need. Ladies and gentlemen, we don't only need to change the industry, the financial planning industry. We need to change the Black asset management industry, because those are the people that manage the money of our clients. On the list platforms, many of those platforms still require the approval of existing advisors to include asset managers on that platform, which means that members of this audience today can help by changing that industry by voting these Black asset managers onto those list platforms, so that we not only change the financial planning industry, but we change the Black asset management industry and the asset management industry as a whole, so that we can grow together. If you can't vote in platforms, if you can't speak to enterprise development funds, if we have many years of experience in this industry, what we can do as part of this audience is take on those young Black advisors into our practices. Let's introduce them to financial planning. Let's train them, and let's make sure that they become the competent advisors so that they can carry our country forward. Ladies and gentlemen, as a country, as an industry, I know we are alive with possibilities. As we've proven it before, when we stick together, united in our diversity, when we put our differences aside, we can indeed achieve a lot. We can change the country, we can change the fortunes of the people of this country, because we are the people that deal with their finances. And that, ladies and gentlemen, is the story of Gradidge-Mahura Investments. Baya Danki, thank you very much. Rea leboha, siyabonga.